All right, welcome back, folks, to another Rev Real Estate Live. My name is Dallin Schultz. I am the host of this weekly webinar, as well as the president of Rev Equity Group. The whole purpose of these webinars is to educate, is to make you a better investor in real estate, and more specifically apartments, because that's what we specialize in and that's what we know. Now, whether you invest with us or somebody else, we want to equip you with the right knowledge, resources, and tools to make educated decisions. So these weekly calls, these weekly webinars, there is never a deal that we're pitching. We're not soliciting anything. It's simply education. So with that being said, we welcome questions and we encourage it. So whether you're tuning in live on one of our social media platforms or on here via Zoom, all I would ask is that you throw it in the chat box, your question, and my team is here with me to help mediate that. And so if there's questions that come up, we'll address it when it's appropriate, and we'll try to not get into the weeds too much. And if it's something that requires further explanation, happy to follow up with you after this call. So we try to keep these pretty basic, pretty simple. It's a lot of information. If you've been with us before, you'll know that, and you'll see and recognize that a lot of the information kind of crosses over, and we might mention the same stuff in a few different webinars because it all ties together. There's a lot of moving parts. And again, it's our job and our desire to help you better understand the process of it all. So what we're going to be talking about today is GP versus LP, general partner versus a limited partner. And that term is used quite frequently, but in full disclosure, those terms are used when people are purchasing real estate in a limited partnership, which is not done very often anymore. Much of it is done through a limited liability company. And so what I wanted to talk about first was just the basic deal structure of what it looks like and where this GP-LP idea comes from. Another way that you'll hear these terms being used is the sponsorship team and the passive investors. So let me jump over here to my whiteboard. Okay, so you got an asset here. This is my beautiful drawing of a multifamily building. These buildings are purchased typically using an LLC. Now, again, we're not going to get into super deep structure of this. We've done this on previous webinars. We've had attorneys come on and share some information about this. So, and by the way, we do record all of these and we send out the recordings. All of them are uploaded to our YouTube channel. So if you ever want to go back and look at any of the recordings or webinars that we've done, then you have access to that. So you got your LLC, your limited liability company that's purchasing this asset. How it's typically set up is that you have a manager of that LLC, and this is typically, let me do a different color here so it stands out. This manager is typically your sponsorship team. And we're going to get into more of this. We're going to talk about the roles of the general partners or the sponsorship team and expectations, and the roles and expectations of the passive investors. And the reason I wanted to focus on this in this webinar is because you very much are a partnership going into these deals. Even if you're a passive investor, you are a partner on these deals. So being aware of how these things are structured and what to expect is extremely important. So you have a manager of the LLC. This manager is the one that makes all the major decisions. They carry out the business plan. They work with property managers. They do all that. So within the LLC, again, just keeping it simple here, you might see two different types of shares. And in this case, you have your Class A and your Class B. So your Class A share, this might be comprised of your investors. And your Class B, again, is comprised of your sponsors. And we're also going to touch on what fees you can typically expect in a deal like this. Because again, fees are always disclosed. It's nothing new, but it's important to be aware of these things and why they're justified, in my opinion. And I know that's biased because I'm also an operator, but it's important to understand what goes on here. So we'll touch on this again in a little bit. Very simply, how I'll wrap up this beautiful drawing here is the way the essentially the money flows is any fees that are charged go to this manager. Fees keep the lights on. Fees keep this company in business. And we're going to talk about in just a minute everything that goes on behind the scenes before investors even hear about a deal. So we'll touch on that. And then below that, you have your Class A, your Class B shares. You might see a typical split. I'll just use 70-30 as an example. What this means is 70% of the profits are going to flow into the investors, 30% is going to flow into the sponsors. And the reason this split is very common, you might see an 80-20, sometimes a 90-10. This split here for the sponsors, some people will look at this and say, hey, you're collecting fees up here. Why are you also getting a split of the upside down here? And the reason being, very simply said, the fees, again, keep the lights on and compensates the managers for finding, managing, and sourcing the deals. This profit split down here, that's what incentivizes your operators. That's what incentivizes the management team to knock the deal out of the park, because they only get this if the deal performs. They only get it if the deal performs. So this is very common. You'll see different variations of this, but I wanted to start with that just to give you a basic visual and breakdown of how these deals are structured. And again, all this is disclosed in any of the legal documents and PPMs that you'll see. Before I move on from that, was there any questions? It looks like there's something in the chat box. Paul, is there anything there that we can touch on?
That was actually Paul putting in, feel free to ask questions here.
Oh, okay. Excellent. Let me clear that out so I can see if any new bubbles pop up. Okay, excellent. So now what we're going to talk about is the sponsorship team. And again, you might hear this talked about as GP, general partner, even though legally that's not what they're considered when set up in an LLC. You're going to hear those terms back and forth. So you'll hear me use both of them. So a couple things we'll touch on here. One of the first things a general partnership team has to do is source the deal. And for those that are experienced in the space or have been on the sponsorship team, you understand how difficult this is. You understand that it's more than just going to a broker and saying, hey, I want to buy a deal. What do you have? Sourcing the deal requires time. It requires relationships with the brokers, because this question came up on last week's webinar. What's the best way to source deals? What's the best way to get into deals in this apartment investing space? And across the board, it's dealing with brokers. Okay. Brokers all day, every single day, are connecting with other property owners, buyers and sellers. They are that middleman to connect the two parties together. If you're looking to get actively involved in this space and you're not building relationships with brokers, you're going to be missing out. And the reason is because brokers, they are human lie detectors, right? They are able to connect with you and within a few minutes know and have an idea of where your experience level is and where your team's experience level is. And because of this, it's not uncommon for brokers to have we call them pocket listings, right? They have a few names in their pocket. They might have 5 to 10 operators that they know that if they bring a deal to, that operator is going to close. And that takes time. It takes experience. It takes that the operator actually needs to perform and close on a few deals. So sourcing the deal, it's so much more than just going to a broker, meeting a broker in a market. It's getting onto their short list because it's extremely competitive in this space. And any real estate market, any real estate asset class is going to be extremely competitive. So working on sourcing the deal takes a lot of time, skill set, communication skills, knowledge, expertise. And with that, on top of that goes market research. Operators got to know what markets they want to target, what they want to, where they want to invest, and they connect with brokers that specialize in that market. This stuff takes a lot of time. So you got sourcing the deal. Another big one, and some of these will cross over onto the passive investor side, but maybe not to the same extent or level of complexity. And we'll talk about that. So underwriting the deal, underwriting a deal is so much more than plugging, chugging numbers. I was talking to somebody yesterday, and we were talking about how they were wanting to underwrite deals, and said that they went through a 3-day course to learn how to underwrite. And I said that's a great start. That's an awesome place to be. But in my experience, it takes an operator, at minimum, somebody that's new in the space, a good year before they even start really getting comfortable with the numbers in the market. When you underwrite a deal, it's so much more than plugging and chugging. You are trying to determine what the story is behind the numbers. The broker might give you a little narrative, the seller might give you a little narrative, but the story is really in the numbers. How is that property performing? So this expertise, this skill set of being able to underwrite deals, you need somebody that's more than just a numbers person. You need somebody, a detective, if you will, that they can look at different numbers in the financial statements and know and pick up on certain red flags. It takes a lot of time and effort. So what's the story behind the plan? And then also with the underwriting, they're putting together the business plan. Here's the property that we're purchasing. What can we do to it based on the market to get it to look like this property over here? And with that, they're formulating and putting together the business plan. It's a lot of work behind it. So you got the sourcing the deal, you got the underwriting, and then you got submitting offers. Now, in smaller multifamily, smaller commercial deals, it's not uncommon to go direct to seller, have some direct marketing. But once you start getting into larger deals, again, it's done through brokers almost all the time. So submitting offers, again, that's more than just taking the template, a boiler template contract or letter of intent, and sending it over to the seller. Submitting offers takes negotiation. It takes strategy to know what is it that the seller's really looking for. What is it that they want? And it's not always the highest offer. It's not uncommon, especially in this space, that the surety of close can often outweigh the highest number, depending on the relationship there. So submitting offers and being strategic with that. And anyone that's been in this space knows that this process of sourcing deals, underwriting, submitting offers, this is a continuous cycle. You might go through these 3 steps for months, 6 months, 12 months before you even get into a deal. Because you'll source a deal, you'll underwrite it, and most of the deals you underwrite may not even make sense for you and your team, or you're not comfortable moving forward with it. So then you go back to sourcing more deals. When the numbers do work, it's not uncommon to feel like, what did I miss? Why do the numbers work on this deal and they didn't on the previous 15 or 20 deals? So you dig deeper and you keep underwriting it and almost looking for a reason not to do the deal. And if it keeps penciling out, that's when you move on to your LOI phase, your submitting offers. Now, just because you submit an LOI and it gets accepted, an LOI is a letter of intent. It's a non-binding contract to you and the seller saying, hey, Mr. and Mrs. Seller, these are the terms based on our initial analysis. This is what we're willing to pay for the property, and here are the terms outlined below. If that gets accepted, that's a huge win, but it doesn't mean that you're under contract. They may have accepted 4 or 5 other LOIs. So you've still got to compete with other people and get into best and final. And then once your offer is actually accepted and you have a signed contract, that's when you're officially under contract. Nothing is worse than going through all these steps, getting into best and final, and then losing out on the deal. Just going through that could take 6 to 12 months on some deals. There's a lot of time, effort, and energy that's incorporated into it. So after submitting offers, let's assume your offer gets submitted. Then you have all the legal work. You got to structure the entity, you got to put together the private placement memorandum. Now there's attorneys on your team that are going to help out a lot with this, but it's still you still got to know as an operator how to structure these so that it's a win-win for you as the operator and for your investors. Another big one is to secure financing. The majority of these projects are purchased using some sort of leverage, some sort of financing. And that can range anywhere from covering 50% of the purchase to 80% of the purchase. So simple math, if you had a $10 million deal, you might get a loan for $5 to $8 million of that. And then whatever is remaining is what you would raise from your investors. So securing the financing, knowing what loans to use for that particular asset, and then knowing what terms and plugging those terms back into your underwriting to make sure that the deal still makes sense. And in some cases, it's your sponsorship team that's signing on those loans, full recourse. They're always going to sign on loans. You'll have non-recourse and you have recourse loans, different options. Again, we covered that on another webinar, but if it's a full recourse loan, these people that are securing the financing, these operators, they are putting their financial assets and balance sheet at risk to take on this deal. So that carries a lot of weight to it. So after you get financing, let's say the deal keeps moving on, you've got to raise the money. Now, I've heard this before. I 100% do not agree with it. And what that statement is that if you find a good deal, the money will come. Some of you on this call have probably heard that before. That's a load of crap, in my opinion. You've got to have the relationships. You got to have access to the capital, and then the money will come. So again, being able to raise capital to close on a large deal takes time. People at minimum are investing $50,000 to $100,000 of their hard-earned capital. That doesn't happen overnight. It takes time to get yourself in a position to be able to attract that level of capital and commitment and that level of trust with these people. That takes a lot of time. And then the last one, which is actually the most important, is managing the asset. So once you go through all this process and you get the deal closed and you get ownership of it, the next 3 to 5 years, it's all about fulfilling the business plan. And if operators aren't tuned in, don't have good systems and processes to manage the asset, you can have a really good deal with a bad management team and they can run it into the ground. And on the flip side of that, you can have an okay deal or a decent looking deal with the right management team and they can hit it out of the park. So this managing the asset is huge. And so that's where, as you're looking to invest into deals, make sure you really get to know who your operators are. And we're going to touch on that. So I wanted to gloss over this just so both sides, people looking to invest and other operators, can better fully understand really what goes into these types of deals. Now, I think what I'll do now, I'll touch on this real quick. I'm going to touch on some of the fees that you will likely see. You have an acquisition fee. You'll see that in almost every single deal. And this is typically 1 to 3% of the purchase price. So it's not uncommon for investors to say you got a $10 million deal, okay? And let's say these operators took a 2% acquisition fee. That's $200,000 for an acquisition fee. And some investors are a little uneasy about that. But one thing to understand is when the investors are brought on to a deal, it's at the time of typically the LOI being accepted. And if the deal goes smoothly, that deal closes 2 months later, 45 to 60 days later. Okay. It's not uncommon for investors that are passively getting involved in these deals to look at that and say, hey, it only took you 45 to 60 days to close on that deal, and you're getting $200,000 for that. I'm not really okay with that. It happens, and that conversation comes up, and that's where good communication comes into play and education. And that's exactly what we're doing on this call. I showed you everything that goes into the deals. If it takes an operator 6, 9, 12, 18 months that he's been working with brokers to get into that deal, that 200,000 is actually very minimal of the time and effort that they put into it. So you got your acquisition fee. You'll also typically see an asset management fee. And this is usually 1 to 2% of the revenue, gross revenue generated by the property, the total money that's brought in. And that asset management fee is paid out monthly. That goes to the management team. Again, just to keep their books going, keep their employees going, and keep some food on the table. Then you'll also see you'll often see, depending on the project, you might see a construction management fee. And if this is where you might see this is if it's a heavy value add deal and people are going in and they're putting in $15,000, $20,000 per unit and they're renovating 50 to 60% of the units. That's heavy construction management. Now, these people might have their construction team in-house, so they have more control of it, or they might partner up with a third party. If it's in-house and they're managing that team, you might see maybe another 10% of the total renovation budget, or I should say renovation, not project. And that's just additional construction management fees going into the company. Last one I'll touch on, and again, you might see different fees in different deals that you do. All of these fees are disclosed in all the legal docs. So if you're not sure, go to that area in the PPM and the operating agreement and really check to see what fees are being disclosed. Your disposition fee, that's usually charged 1 to 2% of the sale of the property in 3 to 5 years. If they decide to refinance it, you might see a refinance fee in there because there's still work and balance sheets and a lot of additional time that goes into either the sale or the refi of a property. So that's a quick breakdown of some of the fees that you'll see. And it's important to be aware of these because these fees are paid out before your distribution as an investor. So you don't get paid your distributions and then whatever's left over, fees are paid out to your operators. So it's important to understand how this money flows so that you can see how the business plan is broken down. I'm wrapping this up. I don't see any questions in the chat box. If you have anything regarding the GP rules or fees, then feel free to share them now. Excellent. Okay. So I've shared this before. I'll share it again. This is our process at Rev of how we partner up with other operators. And I share this with people looking to passively invest as well. And it's a simple 3-step process, vetting process. Okay, so number 1 we say to vet the operator. Then number 2 is the market. And number 3 is the deal itself. And I mentioned this earlier, the reason being you can have a really good deal and a really bad operator, and they can drive that deal into the ground. On the flip side, you can have an okay deal with an excellent operations team, and it can really hit that out of the park. I saw a question pop up. Let me jump to that real quick. What's a competitive waterfall these days? Example is a 80-20 sponsor waterfall typical, or a sponsor is able to get 70-30 splits. I don't have an answer. The great question, Rick, for that. I don't have a typical or an average. You'll see 70-30, you'll see 80-20. At the end of the day, it's whatever makes sense for the deal. So every deal is going to be a little bit different. You'll often see a preferred return as well in some deals, meaning if it's an 8% preferred return, then your investors, you as an investor, will get 8%. You'll get 100% of the cash flow until you hit 8% year over year on your money. And then at that point, you'll see a split, maybe 70-30, 80-20. There's some deals that don't even have a preferred return. It just says, hey, the money's flowing in and we're just splitting it straight 80-20. So you're going to see different structures with different operators. And that's why it's important to know these things so that you can align your goals and the way you feel about real estate investing with similar operators. So it's really going to be different for everyone. Rick, I wish I had a more detailed response for you, but in reality, that's what it is. Every deal is going to look different. Every operator is going to provide something different. It's not that one's wrong or one's trying to cheat you. It might just be the way that they were trained and the way that they were taught. So you as an investor need to be aware of these things. So again, you can align your goals, investment goals, with the right operator. Great question, by the way. Okay, so operator, start there. One of the first things as a passive investor that I would look for, and this can happen very early on in the getting to know the operator process, is, I'll go red here, communication. A couple stories I'll share with you with a couple people that I know. So one of them, first one, there's this deal that this investor had wired $50,000 into. They had not closed yet. The operator was raising money for this deal, and they were expected to close in about 30 days. So he wired $50,000 in, and found out that the scheduled date of closing was actually pushed back another 2 weeks. That happens. That's not uncommon. The issue was he heard about this close date being pushed back, not from the operations team, but from somebody else that they knew that wasn't even involved in the deal. So it was a mutual connection, a mutual friend. And so the actual investor in this deal heard that the deal was getting pushed back from somebody else that wasn't even in the deal or on the operations team. That does not look good. And that comes down to communication. That operations team shouldn't have said anything to anyone until they informed their investors that were currently in on that deal. Communication is huge. And so how do these when you first connect with these operators, what's the communication like? Are they following up? Are they providing resources? Are they answering questions? These are things that are important to look for. Because unfortunately, you'll find operators that are so focused at just finding the deal and closing it that once they get your money, you don't hear anything from them, or it's difficult to get responses from them, which is so wrong. In my opinion, it's so wrong because you're providing that investment to them. So you expect that reciprocation. If you have questions, if things come up, you should be able to contact your operators. So that was one experience. Second experience, working with someone where they had went into another deal. They invested into another deal. They wired $50,000, and it had been about 6 weeks, and they still had not received confirmation from the operations team that that money was even received in their account. So he's assuming they received it and they had it, but that's 50 grand. That did it go into the wrong account? Did it go to somebody else? Did it go to a different bank? So it's little things like that that can often get overlooked, which when you're an investor putting your money into these deals, you want to be informed. You want to make sure that these things are being communicated over to you. So communication is, I'd say, one of the most important things to look for when you're looking to passively invest in a deal. Because if they're not communicating good upfront with you, what happens when crap hits the fan on this deal? What are they going to communicate and not communicate with you? And that's a good question to ask them. When you're getting to know the operator, say, hey, I understand that no project goes perfectly. Can you share with me some examples, some situations of when you would communicate a challenge that you're having with the property, or when something didn't go as planned, and when would you not share that with us? And here's the deal, like, no operator is going to share with you 100% of everything that's going on in that property every single day, because that's the benefit of being a passive investor in these deals, is that you have your operations team handling all the day-to-day headaches so that you don't have to hear about it. But it's still important to know, like, when would we hear about it? If crap was to hit the fan, when would we hear about it? How would we hear about it? Would it be a phone call? Or would you just throw a general message into our portal that goes to all the investors on that deal? And different operators will have different responses to that. So again, it's part of aligning what you're looking for with the right operator. We talked about fees. So find out what those fees are. And if you feel like it's high for that operator, ask. There might be a reason for it. I shared with you that 1 to 3% is pretty typical for an acquisition fee, okay? If one operator is charging 1% and another operator is charging 3% on 2 different deals, what would be the reason for that? Was it a deal that was completely off market, extremely exclusive, and nobody else had access to it, and it's a home run deal? If that's the case, then they might be able to justify a higher acquisition fee because of the exclusivity of that deal and what they're bringing to market. So it's just important to ask those questions, and don't be afraid to ask them. And then this one goes without saying too, but experience. Now, in the apartment investing space and commercial real estate space, doing syndications, funds, people partner up, teams partner up. So you might have one person that might have a couple years experience partnering up with someone that has 15 years of experience. So ask what the combined experience is and find out what partners are on the team and what roles each of them have, because that'll help you better understand the experience that goes into it. Next, what I want to touch on is the market. So once you've vetted your operator, once you've gone through the operator and you're looking at the market, here are a few metrics that you want to look at. Number 1, job growth. 2, population growth. We also look at household income. And we also look at home value and crime. I don't know why I did crime and capital. So these are 5 metrics we really look at when looking into a market. What's the job growth? What's the population growth? Household income, home value, crime. All these things, ideally, you'd want to go up, obviously, except for crime. You want to go down. And when you're looking at these markets, and listen, this is your role. This is your job as a passive investor. Okay. So your operators should absolutely be doing this as well. But you as a passive investor, at the end of the day, it's your capital that you're investing. So you do whatever due diligence that you're comfortable with before investing into these deals. I'm sharing with you the things that we look at that may be helpful to you. So we don't look at these numbers over 2 to 3 years. We look at these numbers over the last 15 to 20 years. And if we're looking for a market that's experiencing job growth, population, household, home value, we're looking for that upward trend. Obviously, if you're seeing a downward trend, then maybe you will question that market. And here's the deal. This is on a very high level scale. Every market has submarkets, and you're going to find people being successful in real estate in every single market. That's my disclaimer. So what we look for is those major markets like Phoenix, Dallas, Houston, Nashville, a lot of markets in Florida. We're looking for these markets that high level view, the numbers are going upward. Now, even though Phoenix is leading the country along with a few other cities in a lot of these areas, there's still parts of Phoenix that I want to invest in. So keep that in mind. Okay. But this will give you a general idea of what to look for. So we target markets that are rising, that are growing, and that are experiencing less and less crime. So we have a really cool tool that we use to vet this, and it's actually provided by Neil Bawa, has a really cool resource that he uses to vet these as well. So if that's something you're interested in, you can connect with us after this call, and happy to share that with you. So after you vet the market, number 3 is the deal. When you're looking to passively invest, vet the operator first, find out what markets they're in, do your due diligence there. And once those both areas are checked and that alignment is there, then start looking at the deals that they're providing. So with the deals, you may not need to do the same level of underwriting that the operators did, but you can absolutely and should request their underwriting if that's something that's important to you. And again, you're partnering in on this deal. So if there's some of these items that operators and sponsorship teams don't want to readily share with you, then question that, or find somebody that is willing to share that with you. So you want to review the underwriting. You'll want to look at the equity structure. And this kind of goes to the question that was posed earlier. Is an 80-20 sponsorship waterfall typical, or are sponsors able to get 70-30 splits? It depends. Okay. But every deal will disclose what that looks like. And for example, a deal we just closed on, actually our most 2 recent deals, we had 2 different structures for passive investors based on how much they invested in that deal. So that stuff will be disclosed. For example, on the deal I was just talking about, we had Class A investors, Class B, and then we had Class C. And this is, again, just an example, but to help you understand what to look for. So your Class A, this was investors that put up $150,000 minimum. And so what they got was an 8% pref and an 80-20 split of the profits. Your Class B investors, they had a $50,000 minimum. They had a 7% pref with a 70-30 split. And these splits, this 80% goes to the investor, 20% to the operator. And the Class B, 70% to the investor, 30% to the operator. So we're actually, Rick, to answer your question, this is something I'm starting to see more and more of, because at the end of the day, you might have an investors anywhere from 50,000 to 500,000. So if somebody's putting up $500,000 into the deal, as an operator, how are you incentivizing them? How are you giving them preferential treatment since they're putting up so much more capital? Are you going to treat them the same way as your $50,000 investor? Maybe. And some people do that. It doesn't matter how much money they put in. They're like, this is what it is. So again, look for that. If you're looking to put up a few $100,000 into an apartment investment or syndication, you might want to be looking for something that has different tiers so that you get some preferential treatment. And along with this, another thing that you'll want to look at is the capital stack. And again, we've touched on this on previous webinars, but I'll touch on it briefly here. Your capital stack is how the money is paid out from the deal. So your primary lender, your main lender, they are going to be paid first before anybody else. So you got your primary lender, and then you'll have your investors, and then you'll have your operators that get paid last. So in our deal here, when you looked at the capital stack, so this might be your loan here. When you look at your capital stack, you got your loan, then you got your common equity, which is the investors. But how we had it was that Class A investors would get their capital returned first. And then your Class B, and then the sponsors. So it's important to understand how that capital stack is set up. Again, so you can determine if it aligns with your goals. And what this does is people putting up more capital, it's putting them a little bit in front of the Class B investors to make sure that they get their capital back first. It's just part of that preferential treatment. Again, all of this is disclosed. It has to be disclosed in all the legal documents. And in fact, next week on our webinar, we're going to be, we have an attorney coming on that's going to be talking about how to look through, how to read through a private placement memorandum, a PPM. And if you're not sure what that is, in short, your PPM is 60 pages on how you can lose your money. I don't know how else to say it. That's really what it is. And it's not to scare anyone, but it's all the disclosures that go into these types of deals. But this stuff is disclosed on there. And so we're going to have that attorney on next week, and he's going to be breaking it down so that as you're looking through and reviewing these PPMs, you can look at the core areas and know where you want to be or what to look for. So the equity structure, capital stack, the last thing that I would touch on regarding the deal, and this is a big one, it really is what type of loan is being used on that property, especially in today's market. There are so many different types of loans. And when you're in the commercial real estate space, you have a lot more different options to become familiar with. So what loan is that operator using? Is it a floating rate? Is it going to adjust with the market? Or did they purchase a rate cap on it so it won't go up a certain amount? Is it a 10-year loan? Is it a 7-year loan? Is it a 5-year loan? Is it fixed rate? Is it floating rate? A lot of these things and questions are things that you need to be aware of as an investor, because if that loan fluctuates, that can severely alter the business plan of the property and of that deal that you're getting in. So as for deals right now, if I could give any suggestions, any thoughts, if you're looking to get into deals, fixed rate for 5 years or more. And that's just my opinion, my thoughts. If you're looking to get into a deal, make sure that it's a loan with a fixed rate or it has a rate lock on it for at minimum of 5 years, because we're experiencing these ups and downs in the market right now. So this is stuff that you want to be aware of as an investor so that you can make wise investments. And listen, I understand that this seems like a lot of work, right? We talked about the operator, we talked about the market, we talked about the deal. If you're new to this space, it does seem and feel like a lot of work, but I want to ask you a question. I want to pose this question, consider it, and actually I'm looking for some interaction. So feel free to type this into the chat box. If you don't want other people to see your response, just send it specifically to me so that I can see it. The question I have for you, and take a second to think about it, what would you consider a good hourly rate to be for yourself? Where do you currently value an hour of your time? Is it 20 bucks an hour, 50 bucks an hour, 300 bucks an hour? Think about that for a second, and then I'd like you to put that into the chat box. I'm just curious to see where people's thoughts are regarding this. And again, if you don't want others to see your name and your response, then just send it directly to me, or you could post it to everyone, whatever you want to do. Ten more seconds, and then we'll wrap this up. Okay, so we've got $100 an hour, $50 an hour, $300 an hour. Someone's not sure. We got $50 an hour, $130, and okay. So we're ranging anywhere from $50 an hour to $500 an hour, right? That you can have a comfortable living off that, let's be honest. But I'd imagine that most of us want much more than that. And it's not about the money, it's about the freedom, it's the flexibility, it's the time, it's the way we can give back, right? I know I'm speaking for everyone, but I know that's important to a lot of us. So the reason I posed that question, okay, and this is important, I shared with you all the things as a passive investor that you should be doing before vetting a deal. The first one you do will be scary. The very first real estate investment you get into will be scary. There's a lot of unknowns. You're getting out of your comfort zone, and that's a good thing, but you want to be educated. You want to be prepared. So your first deal you look at, you might spend hours vetting that deal, vetting that operator, and you do what you got to do to feel comfortable for that deal. But I can assure you and promise you that as you do more and more of these, you're going to get more and more comfortable with this process. You'll know what to look for, where to look for it, how to vet it. And what we focus on at Rev, and this is pretty typical across the board. We work and we target to double our investors' money in 3 to 5 years. So if somebody puts in $100,000, 3 to 5 years, our goal in total is to return $200,000 to them. So they get their $100,000 investment back and they profit $100,000. That's what you'll hear and see in the space as a 2x equity multiple, right? That's our target. Those are the types of deals we try to look for. So if you were to put $50,000 into a deal, and now listen, when you come in as a passive investor, yes, there's this work up front that you're doing, but once that money's in the deal, the operators are taking care of it for the next 3 to 5 years. So that's where you could sit back, look at your financials and updates as the operators upload them to your portal if you want, or you just put it in and you forget about it. Everybody has different experience levels and comfort levels. But in reality, once you vet the deal operator and you fund that money, there's really not much more you have to do at all until that deal sells. So the reason I asked what you consider a good hourly rate to be is because sharing what I did with how we try to double investors' capital. Okay, you put in 50,000, we want to give you 100,000 back, 3 to 5 years. If it takes you an hour to vet that deal, to vet that operator, and to feel comfortable sending and wiring that money, in reality, if that's the bulk of the work that you're doing, you're making 50 grand an hour. If you want to look at it and think about it that way. An hour of your time vetting a deal operator. Now, again, your first deal, it might take a few hours, right? That's expected. But once you get comfortable and get into this rhythm, would you consider 50 grand an hour a good return on your time? I would. So that's why I was curious where people felt like a good hourly rate was. And the reason I bring this up is because we work with a lot of business owners that are extremely successful. And one of the most reoccurring, it's not an objection, it's more of a, hey, this is why we didn't get back to you, is because they're busy. They're busy, they didn't have time, they're interested in investing, but they didn't have time to vet the deal. If we were able to show you how to vet a deal, an operator effectively in 1 hour or less, to where you could be making 50 grand an hour, would you make time to hear us out? Would you make time to look at that deal? So it's just kind of ironic, and that's why I wanted to share this with you, because a lot of us want to get into real estate to get our time back, but we won't put in the time required to get into real estate. And people have different interest levels. We have people on this call that are active operators. We have people on this call that are just looking to passively invest. Regardless of what you want to do, we all have different goals. This knowledge, the information that I shared with you today, it's important to understand and know across the board, regardless of where you're at in your process and in your journey. So as an LP, start with your operator, look at the market, and look at the deal. And then we'll talk, and then consider these other talking points that we discussed in here. You talked a lot about the GP side and acquisition mode, but what does the GP group typically do after closing and during the hold of the property? Excellent question. Honestly, we could have multiple calls just on the asset management of these deals. So during the acquisition phase, the general partnership team, given their previous experience looking at the financials of the deal, they're formulating this business plan. They're saying, hey, based on this information, this is what we're going to present to our investors. That's in theory, right? They do the best they can to project those numbers, and that's what they present and sell to their investors. But the real work comes in once you close on that deal and actually executing that business plan. So if operators are too aggressive on their underwriting and they're not allowing for enough wiggle room, that could ruin and destroy the business plan during the operation side. So as an investor, you want to make sure that they're taking a conservative approach. Is there wiggle room? Is there buffer room? Nobody has a crystal ball. Most people go into these deals wanting a 100% surety that their capital is protected, that they're going to get all of it back plus more. The reality is, with any investment, the risk is you could lose it all. But what is this team? What is that team that you're working with? What are they doing? What steps are they putting in place? What conservative approach are they taking in their numbers to mitigate some of that risk? Because once you start implementing the business plan, now it's managing people, and people are unpredictable. You're managing contractors, you're managing the property managers, you're managing the staff on site, the management, the groundskeep, the landscaping, the roofers. It's very heavy management intensive. And so if you don't have a team with the right systems, processes, and relationships to effectively execute that, that's where you could take a nice, beautiful looking deal, and this is what you were sold on, and just drive it directly into the ground because they failed on the execution. They might be good at packaging it and selling you on this vision and this idea, but when it comes to executing it, that's where they fall short. So after you close, again, that's where it gets heavy into the management. Weekly calls with the property manager, looking at the numbers. Are they leasing up? Are they turning as many units as you were projecting on the plan? Are they collecting that income that you were projecting? Are they raising rents? Are they keeping the units full? So depending on the level of asset, it's going to require different levels of asset management, some much more intensive. So it really all depends, but great question. We got another one here. I have a lot of cost segregation clients who are residential investors, but they want to scale up into multifamily. However, they aren't quite ready to pencil a deal, chat with brokers, etc. I often recommend passive investing with a smart, experienced team like Rev. Oh no, sorry, I think I added that one in there. Because of the financial benefit mixed with the education, can you speak more about what a passive investor might gain experience-wise for investing? Is that, Tyler, clarify, is that just going passively into a deal? What type of experience they can gain from that?
Yeah, sorry to jump in. So yeah, just a lot of people that are like, hey, if I throw like 100 grand. Oh, can
I'm
you hear me?
sorry, let me check my speaker.
I can type it again, but it takes a second.
We can hear you, Tyler. The rest of us can't.
Okay.
Okay,
So yeah, just a lot
again,
of those guys.
Tyler.
Yeah, just a lot of those guys that have like, they got 12 houses, but they're like, dude, I just want to scale up into that multifamily world. But they're thinking, I'd rather just throw 200 grand into a team like Rev because they get to kind of see the deal firsthand. How much information are you passing back to an investor like that they could learn over the course of that 3 to 5 years?
That I'm really glad you actually brought that question up. And I'll be honest, it depends. It really depends. And unfortunately, you'll see that happens a lot because people want to get into larger apartments. They understand the idea of partnering with an experienced team, but they want more than just the return. They want to invest with that team to get the knowledge and the experience. So you got to find an operator that's willing to do that. So for example, one of the things that we're actually putting in, because we find that quite a bit, Tyler, so that's why I'm glad you brought it up. What we're going to be doing and implementing is with our investors, we're going to start putting in and having exclusive monthly calls just with our investor group. The stuff that we share on these webinars is very high level. It's super basic. It's general understanding to at least point people in the right direction. With our investors, though, we want to provide that education because a lot of people just don't know that this is even an opportunity or an option. And we're looking for partners. We're not just looking for capital. We want to educate, we want to inspire, we want to motivate. So that's one of the things that we've talked about as a team is putting together these monthly calls specific to our investor group where we dive deeper into these things that we talk on webinars. Now, that's something that's unique to us. Not every operator does that. Some operators do a hell of a job executing the deal, and they may not provide any additional education. So if that additional education isn't important to you, and you want to partner with someone that's absolutely just going to crush it out of the park, and you're okay having that limited exposure, then partner with that operator. So again, it really depends. Unfortunately, what I've seen more often than not is operators connecting with investors, telling them on this idea, vision, and come invest with us and you'll learn what we do behind the scenes. And then they don't really hear from them once their capital is invested. And that's unfortunate because a lot of people don't just want the passive return. They want the education, they want the knowledge. So again, it's just finding an operator that's willing to take that time and to coach and mentor along with the return on the capital as well. Did that answer your question?
You knocked it out of the park. Great stuff.
Excellent. So yeah, like I said, there's so many different operators in this space. It's not unique. And the more you go down this path, you're going to find more and more people doing it. And at the end of the day, it's just finding the one that just feels right and resonates with you. And that's why we're really passionate about this education and doing these weekly webinars. It's just to better equip you to go out and make educated decisions with whoever it is. Because at the end of the day, it's a team sport. We all want that financial freedom. We all want to buy our time back. And we can very much do that together if you know what you're getting involved in. So excellent questions, everyone. Thanks so much for tuning in to today. We do have this recorded, so we send these out Tuesday mornings if you want to refer back to it. Like I said, you can also access them on YouTube And what I'll actually do, and let's do this right now. I'm gonna type in our assistant's email into the chat box. What I've put together for you, since you all took time out of your day to come join us, I put together a list of 15 questions that you'll want to ask an operator, or 15 questions that you should ask an operator that maybe you didn't consider or think about asking. So that's a free resource. Again, additional content, education for you. I put Hillary's email into the chat box. If you want that, email her, request it, and she'll make sure that she gets it over to you. So I'm not sending that out in our general email. So if you want it, take advantage of it now. Again, thanks so much for coming out, folks. And next week, we're going to be talking more about the PPM and what to look for, because I'm almost certain that 97% of us can't stand legal jargon or legal documents. So that might be a good call just to jump on and know what to look for when these deals are presented to you. So thanks for coming out, everyone, and we'll see you next week.